Welcome and thanks for having us, Jasper. We're ROK Resources, and so I'm going to walk you through investor presentation and give you an introduction to the company, introduction to myself and the team, and then we can follow it up with your vast array of questions. So ROK Resources, we're a company based out of Regina, Saskatchewan, Canada. We've compiled over the last few years about 3,800 barrels a day of production. And it's come from a combination of acquisitions, the drill bit, and a few dispositions over the period. So I'm going to actually fast forward to the team real quick and give you a little bit of a history on us, and then I'll go back to our snapshot. So I'm Bryden, right? I'm the Chief Operating Officer. Cam Taylor, we're led by our CEO. Jared Lakomsky, our Vice President, Land and Business Development, and Lynn Chapman, our CFO. And so Cam, a little history on ourselves. Cam, myself, and Jared, we've been doing this together for about 15 years. And so our history is building and selling oil and gas companies. And we've done that together since about 2007 and have successfully built and sold 4 companies in the past, all in the private space. And so if you look at us now, we're a publicly traded company, and I'll explain why that is and how that happened. But in the past, the 3 of us, as well as some other members of the team at that time, were able to build and sell 4 separate companies, all based in Saskatchewan, again in the private sector, and sell them for a meaningful return to our shareholders. And so over the course of about 12 years, we were able to do that. And obviously we went through multiple, ups and downs in the industry, oil prices, going anywhere from $20 a barrel up to $150 a barrel. And so we managed through all of those different scenarios and different markets, and we're able to provide roughly a 3 times return to our shareholders in each of the companies when you combine them. And so, the first company we capitalized, grew that to 2,300 and roughly about 2,500 barrels a day at its peak, and that was a Bakken-focused company in Saskatchewan. And then we immediately carved out some assets and created the second Villanova Resources. Grew that to about 1,200 barrels a day. Sold that. Did it again with Villanova Oil Corp, and then again with Villanova 4 Oil Corp. And you can see our thesis back then, or our corporate strategy, was to grow these companies from usually zero. We'd start with maybe a little bit of production, but if not none, and go and acquire land and really grow by the drill bit. And so that's what we believe we're competent at, and we were able to do that 4 times and have some success. And so we've now come into the public world. And I'm going to kind of walk you through, where we've been and where we are today. So if I go back to the snapshot of the company, and so this takes us to our current situation, which is about 3,700 barrels a day of production. We've been extremely active over the last 12 months. So we actually went public with a share exchange agreement in early 2020. And so it's been about, 3 years? 3.5 years almost. And we really didn't get active on the M&A side until last year, when we did a large acquisition in March of 2022, bought about 2,900 barrels a day. Since then have, increased our debt up to 70 million of debt, and have now reduced our debt back down to almost zero. We've paid off our term debt, and we're sitting with 3,700 barrels a day. So a lot of ins and outs of assets. We've sold some non-core, non-operated assets. We've picked up additional assets in Q1 of this year from Whitecap, and we've really consolidated our asset base now to 2 areas. So you'll see on the map here, Southeast Saskatchewan, that's our core. That's where we've operated and sold companies in the past. Conventional Frobisher, conventional Midale, unconventional frac Midale. That's kind of the focus out there. And then up in Kaybob in Northwest Alberta, a little bit more gas focused play, but significant reserve base, significant upside out there as well, both on oil and gas. And so we have two core areas. We have an Alberta team that runs the Kaybob assets, and we have a Saskatchewan team that runs our Saskatchewan assets. So I'll fast forward back to slide 5, and you can see kind of what I just discussed in terms of our timeline. So in Q1 of 22, we closed the large acquisition. We actually drilled the best well in Saskatchewan in Q3 of 2022. So we were able to go and drill, put some capital into the ground in Q3 and Q4 of 2022. We did an acquisition, another Whitecap acquisition in Q4, which then closed in Q1 of 23. We refinanced our debt. The original deal back in 2022 was done with, unconventional high interest debt out of the U.S. We then basically consolidated that debt into a more conventional based lending facility. And since then, in the last 30 days, we've actually paid off our term debt. We sold a large an interest in the Weyburn unit, and we're able to completely retire that term debt. And so our balance sheet has vastly improved over the past 3 months specifically. And, we're looking to grow to about 4,500 barrels a day by the end of the year. We're actually going to kick off our drilling program in about probably 20 to 30 days. So we're excited to do that and excited to really take, our consolidated asset base and grow that into, something that is more sustainable in that, 4,000 to 5,000 barrel a day range, which is what we see. So as far as the capitalization of the company and the cap table, we're extremely coming from the private world. Our insiders, our management, our board, we own about 17% of the company, and that's something that we pride ourselves in terms of owning the company and having skin in the game. And Cam, Jared, and myself, we did that from the get-go when we founded the company. Lynn, is also a shareholder, has put his own dollars into the company. And so we're always invested. Our board, we continue to buy in the market. We've participated in all of our equity raises to some degree. And so, we believe in this story. We believe in our assets, and we believe that, we're going to have a successful company. So we trade under the symbol ROK.V on the venture. We also have free trading warrants, ROK.WT, with strike price of 25 cents, and those expire in March of 25. So you'll see, as far as the dilutives go, we have a large outstanding warrant volume, and that's because of the deal we did back in 2022. But again, they are free trading, and all of those dilutives will bring in roughly about $35 million of proceeds. So, if they are exercised over time, a lot of capital will come into the company that we can, then deploy into the ground, return to shareholders, etc. As far as guidance goes over the next, 6 months now. So again, we're sitting in that 3,700 barrel a day range today. Very little debt. We're sitting at about $11 million of net debt currently. And, our plan is to drill about 11 wells over the next 6 months, grow this company to 4,500 barrels a day at exit, generate about $46 million of NOI. And by paying off the debt, as we have, it generates significant cash flow month to month. And, we're not servicing principal, and we're able to put that either into the ground or, as we move into 2024, we'll have the ability to, consider other options, whether that's special dividends, share buybacks, additional M&A, which we're always considering. And then, of course, consider considerable growth as we move forward, depending on how oil and gas prices look. So we expect to exit the year in that $7.5 million net debt range. So a reduction from our current net debt while growing production by about 20%. And so, we're extremely excited about kind of getting back to what we think we're fairly good at, which is drilling wells and finding new plays and, growing that reserve base. So one of the focuses that all this M&A that we've done over the last 12 months was to increase our location count, increase those, upside development locations, both booked and unbooked. And so, with the acquisition of the Whitecap assets in Southeast Saskatchewan, we were able to almost 2.5 times our booked location count from, mid 50s to 115. And, with that, we believe a lot of those are low risk, a lot of infill drilling. We've identified another 75 to 100 locations on our land base that are unbooked. And so, part of the strategy this year is to convert some PUDs and probables into PDP, but also to, try and extend some reservoirs, extend some pools, look to grow that reserve base from the unbooked portion as well. And, our focus this year is Southeast Saskatchewan. That's where we're going to focus our dollars. And, further in the presentation, you can see the economics and why that choice is made at current commodity pricing. But, as commodity pricing, over time increases, and that's our thesis, and that's what we believe will happen. We'll be looking, to deploy some capital and some meaningful capital up in the Kaybob area, where, cost of the well is a little bit higher, but, reserve life and just EUR per well is also higher. So, but yeah, for now and for the focus of 2023, we'll be looking at this land base that you see on slide 9, which is existing land that we had prior to the end of 2022 in blue and the acquired acreage in yellow. So you can see they fit together very well. This is the area that Cam, Jared, and myself operated in for the last 15, 20 years. And we know it very well. Our operational team is out here. They live out in this area of Saskatchewan. We know the landowners very well, and we believe we have a good working relationship with all the players out there. So if you're familiar with Saskatchewan or the basin in Western Canada, you've likely heard of the Frobisher, and so this is a Mississippian formation drilled conventionally. It's typically $1 to $1.2 million a well, about half mile horizontal typically is how you drill them. And, if you find, a prolific pool, the economics here are tough to beat. And I think, behind the Clearwater, they're the best play in North America. So, I think there's 2 Clearwater basins based on some analysis by, I think, Raymond James, and then the Frobisher is right behind it. And, you can see the payouts anywhere from 4 months to 8 months at a variety of pricing, IP rates, typically in the, 100 to 200 barrel a day range. And, you recycle that capital very quickly with recycle ratios of 2 to 4 and, IRRs in excess of 150%, even down at $70 oil, which is, where we sit today. So, this is a play that we focus on. It's a play that we've always, kind of had our toes in Saskatchewan. We've built companies, on the backs of the Frobisher and the Midale. So, I think just looking at the economics, I think you can understand why we're excited about these wells. And then, kind of the sister to that is the Midale. And so the Midale is again, a Mississippian play, a little bit shallower than the Frobisher, often conventionally produced and exploited. So again, same thing, mile or half mile horizontals. We have a mixture of conventional and unconventional. So in the unconventional, you frack these with 25 to 30 stage fracks over the course of a mile well, and that increases your capex up in that 1.8 range, $2 million range. And so the nice thing about the Midale is it provides a little bit longer reserve life. It's water flood. This pool has been water flood since the 50s, 60s in Saskatchewan, and that secondary recovery can often double your recovery. So, the Frobisher and the Midale together are a nice fit. And again, we've built companies on the backs of these 2 plays in the past. So quickly, what we've done over the past 12 months in terms of our leverage and our debt and reducing our cost of debt over the last 12 months. Originally, we had a $65 million loan facility with a group out of the U.S. We were then able to convert that into a $52.5 million loan facility, plus a revolving line of credit for $22.5 million. So when we did that in Q1 of this year, we reduced our interest rate significantly from about 16% down to, I want to say 10, just under 10 on a blended basis. And since we've now paid off that $52.5 million term loan, we're left with just our line of credit, which is drawn at about, I think, $15 million today. But again, we have cash in the bank, and our net debt sits at about $10 million. So overall, we were able to, significantly draw down our debt and our cost of debt. And I think our balance sheet, looks significantly stronger. In addition to that, we've been able to pull off some forward hedges out 24, 25 that are no longer required. And again, we're bullish on where we think oil is going. We want to be, we want to take advantage of that price increase over time, and we don't want to, be hedged. Like for us as a company, we want to protect our balance sheet. So if we're carrying a lot of debt, we will of course have that insurance policy in the form of hedges. As we pull off that debt, I think we want to, I think we'll always have a hedge book to protect perhaps our capital program, things of that nature. But you've seen we've recently released a press release stating some of the hedges that we did unwind, further out hedges into 24 and 25. And so we're very happy with kind of what's happened and transpired over the last year, specifically over the last 3 months, and our balance sheet is in a good spot. As far as peer comparisons, so we trade, in our opinion, fairly cheaply. We believe that we have a lot of torque in our assets and our ability to increase our our stock price and our asset value over time. Our debt to cash flow is obviously significantly lower now in that 0.2 range. We trade closer to 2 times cash flow now, given kind of the pullback over the last month or so. And so, our goal now is to go out and, drill good wells and grow the company and prove to the market, again, because we're a new team to the public market and, a little bit unknown, that, we know how to grow oil and gas companies and how to, ultimately most likely position them to sell at some point. So I won't go through our hedging contract summary, but this is in the deck. We have a solid hedge book over the course of this year, I believe in the $82 US a barrel range for the remainder of the year. So, on the oil side, we have about 75% of our oil and gas hedged, and on the oil side, it's well above current pricing. So, timing was on our side when we hedged these volumes, and then on the gas side, we hedged through summer, and understanding that gas prices have been hit a little bit recently, and there's some weakness, and summer months can often be a little bit more challenging, and so we wanted to ensure we have some protection there as well. So oil and gas, now we're switching gears a little bit here, and it's a little bit of a unique story to ROK, but historically we're an oil and gas group, and that's what we've done, and that's where we've had some success and spent the entirety of our career. And so what the lithium story is unique, like I said, and it came about 2 years ago when Cam, our CEO, was doing some work just looking at some competitors in the Alberta Basin on the lithium side. And so what this is, it's not a mining play, it's a lithium brine play. And so it's essentially targeting the Duperow Formation in Saskatchewan, which is the geological equivalent to the Leduc in Alberta, where there's companies doing the same thing. And you're bringing up this brine or salt water, and there's high lithium content in certain areas. And we were able to go and acquire a significant amount of acreage with high lithium content. And ROK as a company, created the technical opportunity, or, identified it rather. And we then partnered with a group out of Vancouver called Hub City Lithium Corp. And so we own 25% of that entity. And then the other 75% is owned by a public company called EMP Metals. So the way it sits today is we've gone out, we've acquired acreage, we've tested 3 wells, and we've come back with some very exciting results. So specifically at Mansur, we were able to test 2 wells, had concentrations up to 148 milligrams per liter, and we have a consolidated land base there with some infrastructure already in place, and an exciting play opportunity. Moving to the, southeast in Viewfield, we actually drilled a well, tested it, and we released the best or the highest lithium concentrations ever recorded in Canada. So 259 milligrams per liter. To our knowledge, there's never been a higher test than that. And with that, we've kind of on step 1 or step 2 of moving this forward and quantifying the value here. And what we just released was our N43101, so resource study, which is now available on CDAR, and we press release that as well. And so it's basically it's focused around the Viewfield play as well as the Mansur play, and it discusses the potential resource in place of this lithium play. And the last piece of the puzzle here is the technology, so direct lithium extraction. There's probably 50 companies worldwide working on this right now, and we're in conversations with a lot of these. But right now, to kind of summarize the lithium play, we view this as an option to shareholders, perhaps a free option. It's very little capital deployed by ROK. We're at a point where we'll be coming out with a preliminary economic assessment, so that's the next step. We plan to drill 1 more well with our partners this summer, and get this to a position where it's really quantifiable and understandable for investors. What is this potentially worth? And we believe it could be worth a meaningful amount of money to investors. The long-term plan and strategy with this asset would be to spin this out in some fashion whereby shareholders would kind of have a piece of both the lithium and the oil and gas asset. So if you have a share of ROK at that time, maybe there's an ability to then have a share of the lithium story. And a lot of things have to happen, but quickly, that's the summary of our lithium play. It's the technology is evolving, and I think we're close. And then in terms of the operations, it's no different than what we do every day out here, which is bring fluid to surface, process it, truck it, and sell it. And so this is the same thing, just in terms of a different extraction method. So to bring this all together and to understand what are some catalysts for ROK, how do we why are we attractive to investors? How do we move forward in 2023 and beyond? So we believe we've put together a really solid group of assets, Southeast Saskatchewan and Kaybob. Kaybob is going to provide us an ability to, at the moment with the oil and gas prices maybe go on a little bit of a run, or as we get into winter season and AECO pricing starts to climb, we can go out and drill a well up there and really we could add 500 BOEs a day pretty quickly. Southeast Saskatchewan, again, very top tier economics, strong free cash flow generation over the next 12 months as we really kind of stabilize that production base and get to a point where we can drill 15 to 20 wells a year and kind of grow production 10 to 15% a year. And that's kind of where we see this asset base. We will be releasing the PEA on the lithium side probably in the next few months. So that will, provide some additional value and additional clarity on that asset base. And then, like I said, we're going to be, running a 1 rig kind of steady over the next 6 months, starting pretty quickly. And so it's exciting. We're ready to get going. We're always looking at M&A tuck-in opportunities in both Saskatchewan and Kaybob where they make sense. But our focus is very very strategic and very core to these areas, and I don't think you'll see us kind of moving out beyond that. So analyst coverage. So we do have 4 different firms covering us right now. Beacon, Kirk Wilson, Chris at 8 Capital. Echelon, I believe, there's a new analyst starting there, but they did previously provide a report on ROK, and then Bill Newman at Research Capital as well. So I won't go into the appendix. I think that provides hopefully a decent snapshot of where ROK is is today and kind of where we're going. And, we believe that over the course of this year and going forward, we have a solid inventory of drillables with really, really attractive economics and, a fairly cheap company in terms of where we trade relative to our peers.
Thanks, Bryden, for the presentation. Before we move on to the Q&A session, I would like to mention the 3 pillars of ROK's investment case. The first one is the oil and gas production. The second one is the lithium interest. And the third one is the capital structure. The first and by far most important one is the oil and gas production. It's by growing the oil and gas production that ROK Resources could create material shareholder value, which is why we in the following questions will investigate how likely it is that ROK Resources could increase their oil and gas production. Let's start with going back to the past. An important part in ROK's investment case is the 3 principal founders. It's you, Bryden, it's Cam Taylor, CEO, and it's Jared Lekomsky, Senior VP, Land and Business Development. How did you guys come together in the first place?
So, yeah, that's a long time ago now. So originally, when I was in university, I was doing a work program in my engineering, and I started working for a gentleman named Craig Wilvian that I had actually coached his daughter, and I had approached him about perhaps them hiring a co-op student, and he was the only oil and gas company in Regina, Saskatchewan. Everything else was based in Calgary, right? That's the hub of oil and gas, and I was at the University of Regina and looking for that opportunity. And so he agreed to bring me on as a little bit of a, trial. And Cam at that time was the head, geophysicist, VP exploration for that very first Villanova. And so I met Cam and immediately hit it off. And, and then fast forward, over the next 3 companies, Cam became the CEO of the following 3 companies. I believe Jared came on right around the same time as me. He was a former banker, commercial banker, and and I had actually known Jared because I played basketball with his brother and his younger brother, and so I knew the family very well. And Jared was doing commercial banking and doing some lending for the oil and gas group that we were part of, and ended up, joining as a land guy and didn't know anything about it and learned it. And Jared's business sense and that his business savvy is right up there with anybody. And so he was able to come into that role pretty easily. And so, yeah, that's how the 3 of us came together. And then over time, we built and sold these 4 companies with the other, with Craig and the other team and the rest of the team. And then we ended up, going off on our own to do ROK in 2018.
The 4 Villanova companies, if we took the money that you have sold them for and divided by the money that you raised, I think you have a 3x return on that. So there has been a bear market in oil during some of these companies. Have you been able to sell all of those companies at a profit?
So the first 3 were at a significant profit. The 4th one, the last one, we had capitalized that company in 2013, I think. So right before the downturn started. And in our strategy with that company was fracked Midales, which at that time were, $1.5 to $1.8 million. And we're going to go and, get this big resource base and go and build a company this way. When that, when the downturn happened and we had to pull back on spending, that became a bit of a challenge. So in the last company, we ended up raising capital second time, perhaps the 3rd time, at a down round from our original raise. And so for those that participated in those raises, they ended up making a little bit of a profit. For those that didn't and only participated in the original raise, they would have had a little bit of a loss on that. And it was very unfortunate because operationally that might have been our best success case as a company. We grew that very quickly to 2,000 barrels a day over the course of probably 18 months when we got operational. And it was just, we learned some hard lessons in that, in that company, and as far as how we manage our capital and how we, get through these tough times. And so yeah, I believe if the shareholders participated pro rata on those raises, they would have came out with a little bit of a gain.
I think you mentioned it in the presentation, but could you just explain the reason for why taking ROK or why doing it public this time?
Yeah, so I didn't get into that decision, I guess. So what we did in 2018, we sold our last private company, and at that point, the narrative and the capital behind oil and gas, specifically in Canada, was a challenging place to be, and nobody really, nobody was enjoying it, to be honest. And we had just been through a 5-year company with a lot of challenges, and despite selling and being happy and having a success in some regard in that way, we had to decide what was our path forward. And so at that point in time, we identified limited capital, specifically in the private equity space. A lot of these private equity firms on the oil and gas side were closing up shop, were creating clean energy funds, or were just holding onto their capital until they had returns from these other privates. So we were looking at, how do we create an oil and gas company? Do we want to? Is it where we want to be? And so we identified limited private equity. And then on the shareholder side, what do they want? Well, they want liquidity. And, how do we get access to capital and provide liquidity? And so we created ROK as a private company originally, and Jared and Cam and I just kind of bootstrapped that for almost 2 years, about a year and a half, and just picked up some land and some acreage. And then we had this opportunity to go public, and it was something that we thought was, we just kind of felt deep down was the right decision. And we haven't looked back. It's been fantastic. It's been a good learning curve. It's challenging. You have a scorecard that's out there for everybody to see, and you have to hit those numbers. And that's different for us because we're used to just bringing in the money, going to work, and hopefully selling one day and providing, the shareholders with some capital back. So, but anyways, yeah, that's why we did it. And, it's been great. And again, the access to capital, I don't think we would have had that in the private space, and I don't think we would be where we are.
Well, that sounds like a reasonable decision. So let's move on to the oil and gas production, where you can create material shareholder value. So your reserve base has changed with the divestiture of the Weyburn unit and the other non-core assets, and your oil percentage of the reserve has been reduced, but I think it's to 52% in your pro forma reserves. But still, you will be producing more oil in percentage due to drilling at Midale and Frobisher. So could you just walk me through what is sort of the percentage split in this year and in the next year?
So prior to this last set of acquisitions and divestitures, I think we were around that 70% liquids range. So we always had a gas portion up at Kaybob, right? And then we always have a solution gas piece in Saskatchewan. So although we're drilling oil wells, there's always associated gas that comes with that. So I think we were 70-30 to begin with, and then when we did the deal, we sold Weyburn, which was 450 barrels a day, essentially all oil. And then we picked up some oil and gas from Whitecap. So the way it sits today is I believe we're in that 64-ish% oil and NGLs. And, your number could be correct. I'm not sure exactly what the specifically the oil is. But our plan, and as you and I have talked about, is to drill 10, 11 oil wells, right? We're not going to drill gas wells right now at this pricing. That will add a little bit of associated gas, but I think our goal is to kind of creep that oil gas ratio back up into that 70-30 range over time. And, again, that could change if gas prices jump to $5-6 again in the winter and we drill a Montney well, that's going to add some gas. But for us, we're an oil company team. The gas for us, for the most part, historically has been a byproduct. That being said, if there's lucrative opportunities in Alberta on the gas side, we're gonna take advantage of those. But over time, our goal is to creep that oil weighting a little bit back up, in terms of the company.
Nice. In terms of economics, it's much more attractive to produce a higher percentage of oil, at least currently.
And one thing too, I just want to add to that, as far as the market goes, in Canada, we're a little bit landlocked, as many know, on the gas side, right? With AECO and our inability to get it to different markets. So Oil, we are a little bit more bullish on oil than gas right now. And, I think that's, you can see that in terms of what our strategy is and our plan for capital spending.
But in terms of Kaybob, it is currently producing 1,350 barrels of oil equivalent per day. Since you won't be drilling that, I'm not familiar with the production curves for those wells. How much will it decrease in this year?
Yeah, so that, the nice thing about Kaybob is we don't have a lot of flush production out there. So a lot of that is some historical, 1980, 90 gas wells that we had purchased. And so that provides a little bit of a base on the gas side. On the oil side, we did drill one well with Whitecap in Q1 in the Cardium. So you're going to see, those wells decline off by, 50%, say in year one. But, my expectation on that is to see probably a 15 to 20% decline. And it'd be on the lower end because corporately we're just about 21, 22% corporately a decline. And so, the gas provides a nice solid base on that. So it's a little bit lower. It might be in the 15% range. So I think, over the course of this year, I don't have that number off the top of my head, but, if we're 1,300 barrels a day today, by year end, if we do nothing, perhaps we're in that 1,100 barrel a day range, something like that.
Great. So, by the way, just to clarify, at Kaybob, Cardium has more oil, and Montney is where most of the gas wells are situated.
That's
Say that the gas price spikes this winter. How fast can you make a decision and get gas to the market?
Yeah, so we've licensed the wells. We have both Cardium and Montney wells, but as far as the gas goes, we've licensed, I think, 2 Montney wells. So, we would be looking to make that decision probably in September, October, to go and drill the wells. They're 2-mile long wells. So you'd need probably 30 to 45 days to get, these things on production and tied in. But, as far as the gas prices goes, I think we would have a bit of a, an indication in those late shoulder months that gas prices were moving in that direction. And so we would have time to react and, try and get production on by, say, December.
Nice. And how much does it cost to drill one well at Montney? And is the difference between, for example, Montney and Cardium?
Yeah, so Cardium, you're in that $3 to $3.5 million range, depending if you're monoboring or not. And then in the Montney, you're $5.5 million. So, if you compare that to conventional Frobisher well, where you're 1.2 right now with kind of inflation, used to be $1 million or $950, a year ago, 2 years ago. If you're comparing the Montney to the, the capex of the Montney and even the Cardium to conventional Frobisher Midale Saskatchewan, it's, 3 to 5 times the cost, right? But, with that in the Montney, you get some prolific IP rates. You could see 700, 800, 900 BOEs a day of gas with some associated liquids. So, they're very economic once you see that $5, $6 per GJ price.
What's roughly the recycle ratio for the Kaybob wells in general?
I think you got to look at different pricing on that. So, we have that in the appendix in our report, we do. So, recycle ratio on Cardium, from $80 to $100 oils, 2.5 to 3.5. And then on the Montney, it's about 2 to 3 when you look at $4 gas up to $6 gas. So you still have attractive recycle ratios. You still have, again, we're not going to look at anything probably below 2.5-ish. But, and same with, the IRRs, you want to see things, in excess of 40, 50% at a minimum. So that's, the recycle ratios are there. But again, the price point of the commodity is just a little bit higher than what we require down in Southeast Saskatchewan.
As of now, you have 15 booked drilling locations at Kaybob. What potential do you see to increase that on your current land package?
Yeah, absolutely. Like 15 is without drilling a well probably in the last 3 years out there. So those are locations that are low risk that McDaniels has identified, the moment we go out and drill 2 or 3 of those, we're going to add, additional locations, de-risk some of these pools. We also have some other plays that we've identified in the form of some recompletions and some re-entries. And I think, you might see us go and tackle 1 or 2 of those this year, and that could increase the reserve base out there. Like, for people familiar with that, and I wasn't, being a Saskatchewan focused guy, you could have 7, 8 targets in one well. Like, it's pretty incredible what's out there. So it's exciting from that perspective. Then our geo team, they're Alberta guys, and they know it inside and out. And so they're coming up with ideas all the time in terms of, hey, like, here's a missed Viking perf. Let's look at this. Here's, some Nordegg. Here's the, Gething that has only been conventionally produced. How about going horizontal here? Sorry, vertically produced. How about, drilling horizontals? So there's a ton of opportunity. A lot of it is in the gas window, though, right? So there is oil. There's Dunvegan oil. There's Blue Sky oil. There's Cardium oil. In some areas, there's actually Montney oil, but those are the oil kind of targets. We're not in the Duvernay, but on the gas, there's probably another 5 or 6. So it's super cool in that basin. And so there is an opportunity for sure to grow that reserve base and grow that location count.
Nice. I think that ties into my next question is what's your longer term view for Kaybob, since it's so, gas dense?
From a gas specific perspective, or just Kaybob as a whole?
Kaybob as a whole.
Yeah. So, people ask us this question, and we had it asked at a recent presentation that I did, like, are you looking to sell Kaybob because you're so focused on Saskatchewan? And, the answer is no. We believe that we have not extracted the value of that asset base yet. So, would the time come where we would look to vend that off? Perhaps, but I think, we have a lot of work to do up there. We think there's a lot of untapped resource up there. We have a pretty large land base. We have a great team in that area and in the office in Calgary. So, right now it's a focus on, for 2023, it's a focus on Southeast Saskatchewan. We picked up a lot of really attractive drillables in the Whitecap acquisition. We want to go and extract that value and grow that base. And, right now the economics make a ton of sense. We're looking at opportunities in Kaybob, if both on the A and D side, we're looking at, small tuck-ins. We're looking at selling some of our non-op stuff. We're always looking at, how do we make this asset better? How do we make it, more, I guess, how do we position this so that one day when we do go to sell this, and, there's no surprise there that that's probably where we're going to go with, these assets one day. How do we make that the most attractive to that potential buyer? And how do we maximize the value out of these assets?
We will move over to the Southeast Saskatchewan, your core area. But first, I would like to clarify something for the viewers. So, a booked drilling location, does that equate to one well?
It does. So, the way the reserves work is you'll have your producing locations, and then you'll have booked locations. And in the booked locations, it's 2 categories: proven or probable. So proven is a 90% chance of success, and that's just, defined by N41-101. And then the probable is a 50% chance of success. So that's the definition of those. So within a reserve report, you'll have a number of proven locations and a number of probable locations, where the probable locations might be another, 150 meters stepped out to the east of a proven location, if that makes sense. So yes, 1 location per booked entity.
So when you're drilling 6 to 7 wells at Frobisher and 3 to 4 at Midale, how much of that is in the proven category, and how are any of those wells in the probable category?
So we haven't, I guess, to first answer your question, we are still finalizing the exact location order and what we're going to drill this year. But if I'm going to make an educated guess, I'll say, probably out of the 11 wells we're going to drill, 2 of them will be completely unbooked locations, so not even in the reserve report. So an area that, we're looking to perhaps grow and expand and, maybe exploratory in nature. And then probably 6 of them would be proven, and then probably the other 3 be, my math right? Yeah, 3 would be probable. So it's a combination of proven, probable, and then unbooked. And the strategy there is we want to convert. When we sold Weyburn, we sold a large chunk of our PDP, which is our proven, developed, producing, right? So our PDP wedge has come down a lot, and we replaced that with paying down our debt. So we traded a really solid PDP base for, basically eliminating any of that debt, improving the balance sheet. So, our focus is let's convert some PUDs and probables into PDP. Let's try and replace some of those barrels that were lost. Let's get our PDP into a little bit more of a established position. And with that, comes converting PUDs or proven locations into producing.
In terms of news flow for this year, will you release any drill results? And if so, when could we sort of expect the first results to come out, especially for your 2 exploration wells?
Yeah, so to answer your question, will we release some results? I'm sure we will. We will. So we're going to kick off drilling in hopefully June, first week of June, weather pending. Typically, we don't see production on, a well. You drill it, takes 10, 12 days. A little bit of completion work, equipping. You might have that on in, 25 days, something like that. So we would be releasing, say, some initial results for, I guess that would be Q2 when we do Q2 financials, which would come a couple months later into Q3. My guess is we'll release some results at that time. As we release our financials, we'll have some operational results in there. And, I think, for us to do separate releases, it's something that we've talked about. But I think as we, spit out our financials and our results in that regard, that's when we'll have some operational results for the market. And, I mentioned the PEA on the lithium side, that will be coming out as well in the next few months. So that should provide a bit of a catalyst in terms of trying to value that asset.
So when you drill those wells that are not booked as of now, do you start produce right away from them, or will you sort of book them first, or what's the process?
Yeah, so in order to get a location booked on the reserves, you need to prove that production. So it'll be just like any other well. We'll drill it, hopefully have success, and put that on production. And if it's near a facility, we'll tie it in, flow line it to that facility. If not, we'll truck it. But really, it's just a matter of testing that, understanding what does that production look like. Is there a well? Is there an economic play here? Is there future development in the area? And so the booking will come later, and we'll do that internally first, and then really we won't have a reserves update until the end of the year.
In your Southeast Saskatchewan area, could you give us a ballpark figure or some sort of sense on the potential of adding more booked wells?
Yeah, so we've identified, and I believe the bulk of this is in Southeast Saskatchewan. Probably another 75 to 100 locations of potential, and again, that's internally identified. We need to go and put some money into the ground and prove that up. So I don't really have an estimate in terms of how many of those will end up being economic and how many will get drilled, but we do see a large number of locations that have the potential to be converted. We think our land base has a lot of unbooked potential, and we're looking at, again, growing that land base as well. We're not just being stagnant. We're always participating in the land sales. We're posting land. We're looking at strategic acquisitions, tuck-ins, and so our plan is to continue to grow that base and that production, and with the hopes of seeing 5,000-6,000 barrels a day, over the next couple of years here.
In terms of land sales, you're active in the land auctions. What sort of competition are you seeing? Has it become tighter, or?
It is, yeah. It's become really competitive over the last year, I guess. The last couple land sales, there's been some big bids and parcels going for $1-2 million a section, which is high. And so it's for plays that are really economic, in say the Steelman area, that's one that comes to mind where land has been going for $2 million a section. It's you have to sharpen your pencil, and really, if you want something, you have to spend up for it. And so, for ROK, we're obviously a little bit smaller than some of these companies, and we're not, we don't have unlimited capital. So we just, we're strategic in terms of what we're acquiring and how we go about that. And I think, just on our track record in the past year of how we've done that, I think you can see, what our, how we approach these types of things. And, if we really want something, we'll go after it.
With the land market become more competitive, have you become more active in the sort of leasing freehold land?
Yeah, we're always active in that. So it's, there's always a strategy in terms of leasing freehold and then crown, because the crown is posted in its competitive bid process, whereas the freehold, you can go out and acquire it on your own. And so, Jared and our land team is always actively looking at freehold and picking up freehold, and, in some instances, top leasing and doing other things to balance that freehold crown land base. And the crown, for anybody that doesn't know, is generally more lucrative in terms of how the royalties framework is. So there's incentives with the province, and they provide lower royalties over periods of time. And so, having some crown in your within your company's assets is pretty rewarding, and it's strategic. And so I think we're 60-40, 60% of our land base is crown and 40 is freehold. It's in that range.
So with the land auctioning being quite competitive, are you looking for further M&A transactions? And could you describe the ideal or your M&A target profile?
Yeah, so we are. We always are. And I think you just have to be very selective, and we're not looking to, acquire for the sake of acquiring. If you look at our cost of capital, we're trading at a pretty low metric. So if we were using equity, for instance, it would be difficult to go and acquire something when we're trading at, say, 2 times cash flow. We've reduced our debt considerably. So debt, adding a little bit for the right acquisition is definitely in the cards. And I think that's the way we would look to structure things if the right acquisition came along. I think one of our benefits, or one of our strengths, is in Southeast Saskatchewan specifically, is just knowing so many of the players and so many of the oil and gas producers down here, landowners, etc., and being familiar with the assets, and always having conversations with these, ma and pa companies, these smaller producers, companies looking to offload, 200-300 barrels a day here. So, we're very familiar. We've been in communication with a number of companies, and always looking at tuck-ins. I think the perfect acquisition for us is something that complements our land base. I think it's, something perhaps that provides a facility in an area we don't have one, and we can tie production in, or conversely, an area where we do have a facility, and we can reduce operating costs, with an acquisition of, say, some assets that are being trucked, or things like that. But I for us, our targets are, right now anyways, are things that complement our existing assets geographically in the same areas. If we're going to look outside of that, generally it needs to have something compelling and a compelling reason to go after it.
So in other words, you're planning to stay in Southeast Saskatchewan. You're not looking out. You're not looking at acquisition outside of Saskatchewan.
Outside of our Kaybob area, where we're looking at opportunities to do things there. Yes, that's correct.
So a producer of 300 to 450 barrels of oil equivalent per day in Southeast Saskatchewan. Could you give us a ballpark figure how much that would cost to acquire?
I mean, if we're talking specifically Southeast Saskatchewan, a lot of it depends on, is it mature? Is it all in PDP with very limited running room? Or is there a whole bunch of locations to drill? That's going to change what a company's willing to pay for it. What's the decline on it? What's the ARO on it? And by ARO, I mean your abandonment and reclamation obligations. So, there's obviously a ton of things that go into it. Put a number on something, but like I think a lot of deals have been trading in that. Again, this isn't a metric that I recommend using, but like in the $30,000 per flowing range, or in the 2 times cash flow range or 2.5 times cash flow range. I think is a reasonable kind of metric to use, and that's a little bit safer in my opinion than production metrics, because production metrics are it. Again, it depends so much on the quality of the production and what that is, right? Is it oil? Is it gas? Is it, heavy oil, light oil, things like that. So, it's tough to put a number on it, but those are some, metrics I guess you could think about.
Well, thanks for giving the color on that. So where I'm really going for is, if you would do an acquisition, say, acquiring a 300 barrels of oil equivalent producer per day, if your revolving line of credit and and if you would be able to fund it through debt and you generated free cash flows.
Yeah, we could. Yeah. Like,
okay, great.
Let's say it's a $10 million acquisition. That's something that we would be able to utilize our line of credit, perhaps an extension on that, and cash. So, that's definitely in the range of value that we could accommodate.
Nice. Well, that's great. So there's no word that you would have to issue equity unless it would be a larger acquisition, which I
Correct.
don't think you're in your
No, and I think we're very, very cognizant to the fact that we have dilutives out there. We have fully diluted for 340 or 350 million shares, and issuing equity is not what we want to do at this price. First and foremost, we're big owners, we're big shareholders of the company, so we're looking out for our shareholders, which include ourselves. And I think utilizing the right balance of debt and equity is just very important. And I think so far it's been primarily debt, as you've seen with our last acquisitions, right? Our first one we raised 17 million, just over 17 million of equity, and that was a bought deal by Echelon that was oversubscribed. We could have brought in more, but where we had to raise that at 18 cents, we didn't want to dilute any more than that. We wanted to we needed the capital, but we haven't raised equity since then. We've done deals with debt and refinanced debt and sold some things, and I think the non-core, non-op asset sales have been a lot more, in our opinion, better use of or a better way to raise capital or to raise funds than issuing equity.
If we move back to the production, so what kind of variance in the flow rates at the Midale and Frobisher are you seeing in each well? Because I think it's in the average reserve curve, it starts at, I think it's for flush production, 150, 140 barrels of oil per day. So is there a large variance?
Yeah, there is. Like, we had a well we drilled last year that came on at 300 barrels a day for the first month. And then in another pool where we drilled we kind of got a bit more aggressive in drilling the edge of the pool. It came on at 50 barrels a day, and that was an unsuccessful location. So it's very, when you talk about the Frobisher and the Midale, both sweet spots exist, up on highs of structures, and you want to really avoid certain areas, certain lows, depending on the feature. They can range from a 0, and that's the risk that we take in this game, to 500 barrels a day. And you're seeing some of these 500 barrel a day wells out of bigger company or other companies in the basin, and we've drilled some of those in our day in the past, and those are the ones that you really want to target, right? You want to drill a few of those once in a while. But we'll take, if we can average what we use in our type curves, which is about a 10 to 15% reduction from how the reserve evaluator books them, and we use 1 or 2 curves. We don't, we try and simplify what our model looks like. You're going to have some that exceed that, and you're going to have some that come in a little bit under that, right? But law of averages, we think, will hopefully exceed what that looks like in our forecast, and thereby beat our numbers by year end.
in terms of production, so let's say that you exit the year end at 4,500 barrels of oil equivalent per day. In order to sustain that, what's the minimum amount of wells that, on average, that you would have to drill in Southeast Saskatchewan?
Yeah, I'd say 15 to 17 wells probably to sustain that. I think when we drill 20, as we build our models into 2024, and again, are we going to drill a Montney well in that or not? Because that's going to change things considerably on a BOE basis. It's about a 20 well program to try and grow production by 10%, 15%, 22 wells. So to maintain that 4,500 barrels a day, or I kind of liken it to about 15 to 17 wells a year. And if you look at our inventory, that gives us about what's that, 7 years of inventory, something like that. My math might be wrong, but it's in that range, 7 to 8 years. So and that's including Kaybob, of course.
The size of production is, of course, contingent on the oil price. A number of wells are contingent on the oil price. So could you just broadly try to outline, say, if oil sticks at the current $70 dollars per on the VTI per barrel, and what kind of production you would targeting, and if we would have a bull market with, I don't say, $90, $100 dollars per barrel, what kind of production increases that we could see in that case?
So our budget that we released was predicated on $80 WTI. So you may see, if we hang in here at 70, which is, I think we're 71 this morning, maybe we don't drill as many fracked Midale wells toward the end of the year and pull back that a little bit. Not saying that's going to happen, but the economics that we ran and we assumed in our budget was $80 as an average for the second half of the year, and we still believe that'll happen. If oil runs, and again we think that will occur over time, I can see us drilling, say 25 wells in a year and moving production up well over 5,000 barrels a day. And I don't think it also depends on, we still want to be a sustainable company. We don't want to just ramp up production just for the sake of ramping up production, right? And I think the strategy of the company, if we're looking to go into a sale, that that changes things a little bit as well. But we have the inventory, to answer your question, we have the inventory currently to go and ramp this thing up to over 6,000 BOEs a day, maybe 7,000 if we really wanted to. Not going to say we're going to do that though.
Are there any constraints that would constrain you from ramping up production, drilling more wells?
I mean, if capital isn't a constraint, then the answer would be no. We have facility capacity. Perhaps we have to add to facilities or expand those. There's going to be some flow line. Like there's going to be work capital wise, but if outside of that, I don't see constraints. No.
Something that I like about your oil is that it's light and sweet. But what kind of discount let's speak in US dollars are you seeing to the VTI?
Yeah, so a lot of people that look at Canadian producers just assume it's all heavy, oil sands or thermal or like SAGD, WCS quality oil, and so we don't trade any of that. We actually sold our medium to heavy crude that was in Southwest Saskatchewan. We sold those assets, and so we sit with anywhere from 28 to 40 API oil in that range, and I'd say we probably average in the low to mid 30s. And with that, you see, from WTI, if you're talking in USD, to get it up to kind of our Cromer spec, you see anywhere from a $5 to a $6 a barrel differential. And then from there, probably another $2 for quality differential from our exact spec to this Cromer spec. So, if you take WTI at 71 and you take off, $8 to $9 US at the most, that's probably where we would be. So it's nowhere near that WCS, $25 to $30 differential. And with FX the way it is today, and I'm not sure what it is, but it's been anywhere from 73 to 75 cents. It's that that FX, adds 30% to our, to what we sell a barrel of oil for. So,
but all in all, roughly 7-8 US dollars
correct.
compared to WTI. Okay. You also have a smaller amount. I think it's roughly 7% of natural gas liquids, which could be quite opaque to the uninitiated. So, what are the natural gas liquids made up of?
Yeah, so natural gas liquids are made up of propane, so C3, C4, C5, right? So propane, butane, pentane, and then C5 plus really is kind of like your heaviers. Those all trade independently, right? So as you sell your, we blend them as NGLs, say in our financials, but really it's those three, C3, C4, C5 plus, and each gets its own product pricing. C5 plus is very close to what oil trades at. C4 is a little bit cheaper. There's a discount to that, and then C3 being propane would be significantly cheaper. And so when you blend that together, we see roughly around $60 a barrel on that blended NGL. That's kind of what it's been working out to. So there's a discount to WTI, obviously, when you blend those together. But NGLs make, they can be quite lucrative. When you have a high liquid yield gas, which depending where we are, sometimes we do, sometimes we don't. Sometimes it's drier and you don't see as much liquid in it. The NGLs can be worth a lot of money.
When you said $60 per barrel, would that be compared to $80 per barrel of WTI?
Correct.
Let's move on to the operating cost or the operating expenses. So you're guiding for 26 to 27 Canadian dollars in operating expenses per barrel oil equivalent. What are you seeing in terms of inflationary pressures on that?
Yeah, so that's building in, where inflation has taken those costs. We think that's hopefully going to flatten out or level out a little bit here. We're not including any additional inflationary pressures, throughout the rest of this year. In fact, we're hoping to bring our costs down a little bit, if anything, and that's based on just some ability to, retire some obligations, both downhole and surface, which allows us to reduce some of that surface cost, as well as just some consolidation of some facilities and things. So hopefully over time here, we can actually reduce our costs. But inflation over the past 12 to 18 months has been real. We're seeing 20 to 30% increase kind of across the board in a lot of things, sometimes 50% on certain things, more on CapEx. But yeah, we're seeing it everywhere. And, operating costs have gone up. Fuel costs have gone up, obviously. An ability to provide trucks for our guys, that cost has gone up. Like, everything's gone up, but, we've managed it. And I think we're comfortable with that number. Would we like to see it back in that $20 range where it used to be? Yeah, absolutely. And, that's our goal, but it's going to take time.
So you pay roughly 16 to 70% of your revenue per barrel in royalty expenses. If there's a bull market in the oil price and the oil price rises by $20, would that sort of percentage, what impact would that have on that royalty percentage?
Yeah, we run sensitivities on that, and it's not a significant increase. So, as I mentioned before, you have a freehold percentage of your royalties, right? And so that's going to just stay at 17% or 18%, whatever that average is going to be. On the Crown side, as oil prices go up, as gas prices go up, the sliding scale changes, but it's a pretty immaterial increase to royalty rates on a corporate basis. Even if oil was to go up to $100, $110 and average that, I don't know what that percentage is, but you wouldn't see it materially impact the company by any means. Obviously you're going to pay more royalties because you're going to have higher revenues, but your royalty rate might go up by a couple points, point something. But I don't have that number, Jasper. But as far as how it's broken down within ROK's portfolio, pretty immaterial.
I know you covered this very well in the presentation, but I would still like to touch upon, because it's a fairly important subject. So your hedges serves you as of now well at the current WTI price, but with the term long gone, what's your longer term view on hedging, and will it sort of it subside in the future?
Yeah, so we still have a line of credit with National Bank, and so with that comes a requirement to still hedge 12 months out, and so we'll continue to do that. We're currently hedged 75% of our production, give or take, of our PDP production. So what that means is as we add more production, let's say by the year end or by year end we're at 4,500 barrels a day. We may have that 75% of PDP that's hedged will now probably be 60% of our actual production, right? And that changes. And then as we get into next year, we'll continue to layer on some hedges as long as we have the debt. And so we'll always protect that debt. Like I said, it's an insurance policy on your debt that you're carrying on that balance sheet, and you don't want to ever put yourself in a position where oil goes to $30 momentarily and hangs out there for a while, and you've leveraged yourself with some debt and you don't have hedges. It's not a pretty place to be, and we never will put ourselves in that spot. So we've taken that 12 months, which we're required to do and we're comfortable with, and we like having that protection. But anything beyond that, we've now removed. And so, before we were 2 years hedged, we were out 2 years. Now we've pulled off 2024 hedges beyond that 12-month period, and anything in 25 as well. And so, we want to expose ourselves to a climbing commodity price environment, which we believe is going to happen. We're bullish on that. We're not going to be in a position where we completely expose ourselves again, because we're going to have some hedges in place on the 12 months in the near term anyways. And but yeah, it was a conscious decision that we made when we paid off that debt, that we didn't, the hedges were anywhere from $68 to $72 a barrel US, and we're pretty confident that oil is going to be higher than that in late 2024.
On a final note, when it comes to the production, how much does it cost to abandon a well, and what's the operating life of a well in general?
So operating life of a well could vary. You could drill a well that produces 100,000 barrels in 10 years, and that's all you get, and it depletes, and you got to abandon that. And then you could get other wells that could produce for 60 years. You have some wells that were drilled in the 1960s that are still producing in Saskatchewan, and that's just representative of the reservoir. Is it a Midale reservoir that you could water flood that may just continue to chug along? Is it or is it a Bakken play that might have 5, 8, 10 years of life in it? So that life cycle just really depends. As far as abandoning a well, typically you're in that $50,000. It's kind of what we tend to average per wellbore to abandon. To reclaim the lease, it really depends on the age of the lease. It could be a $30,000 reclamation. It could also be a $150,000 reclamation if there's some historical spills on the lease or things like that. And so what we do internally is we've identified some higher priority abandonments and reclamations for this year. We've allocated $2 million, which is almost double the requirement by the governments of Saskatchewan and Alberta. So we're really aggressive in terms of trying to retire these liabilities and be, a steward of obviously of our shareholders' capital, but the environment as well, and put these things to bed when the time comes. And so that's what we're doing for allocating capital to the ARO. Our LLR, which is the kind of the measure of your assets versus your liability in the provinces, are both above 3, I believe. And so we're in a good position that way. We don't have any deposits with the government to protect, unknown liabilities, which is usually a sign of good, health of the company from a liability standpoint. So yeah, we're, it's become a massive problem in both our provinces. The orphan well fund has grown exponentially in terms of these wells that have just been left. And so the government's taking a pretty proactive approach on making sure us as companies are taking care of those assets.
We'll now move on to the second pillar of ROK's investment case, which is its lithium interest. ROK owns 25% of the private corporation Hub City Lithium, which has 2 lithium projects, Mansur and Viewfield in Southeast Saskatchewan, and both are projects with lithium brine, which means that you extract the lithium in a similar way as you do with oil. And our Q&A session will focus on how ROK could extract shareholder value from its lithium interest. Let's move on to the lithium asset. And so you have owned 25% of Hub City Lithium. I didn't get that, but was the remainder of the interest owned by EMP Metals?
Yeah, that's correct.
I mean, you're the operator of the Mansur and Viewfield area, but how involved are you in the drilling and overall development of the projects?
Yes, so I mean, we manage all of that. So we're the technical team with EMP and the Hub City guys. They've added some technical talent to their team as well. But as far as the actual drilling of the wells, completion, testing, monitoring, getting these fluids to test and ultimately to market, I guess at some point, that's what ROK has been doing. So we're the operational team, and Hub City, namely EMP, they're our partner. They, kind of, I guess, will run the corporate side of the business as it evolves, if that makes sense.
But this is not a major undertaking from your side?
Not at all. Like we drilled 1 well with them last year, and we tested 2 wells. And so it takes up very little of our time. We use consultants where required. A lot of the heavy lifting was done, 2-3 years ago in terms of the geo work that was done by Cam and the guys, and then going out and acquiring the land. And now it's, we've hired consultants on the geo side that prepared our 43-101 resource report. We're going to work with independent engineering firm as well as that geologist to do the PEA, and whatever direct lithium extraction company that we end up utilizing. And so as far as our time goes, it's very little. It's a super exciting kind of sidecar thing that we just couldn't pass up. It was really the opportunity, and there was all these wellbores that were available that let's go test lithium here. Like, this could be an opportunity to make a whole lot of money for our shareholders and spend very little capital, right, and very little of our time. So our focus is oil and gas first and foremost, and that's where we are going to make everybody some money here and build a solid company or continue to build that. But this lithium play is something that we believe could be worth significant value if you look at lithium valuations. And don't ask me to put a number on it yet, Jasper, but one day that'll come. And we just want to position it so that everybody can take advantage of that value.
Nice. And one day that will come. And when do you expect that one day to be roughly?
Yeah, so the PEA, I could have asked Cam prior to this meeting, but I think the PEA in sometime this summer, we want to get that out, and then at that point, when you can compare it to the other companies doing the same thing and look at here's our lithium in place, but here's the operating costs, the perceived operating costs, and here's why our resource is attractive. And I think at that point we would be able to hopefully create a mechanism to get those shares into, say, the hands of ROK, and then at one point, at one time in the future, maybe dividend those out or create a structure whereby you as a shareholder of ROK would also have a share of ROK Lithium or whatever that may be. So these are just things we're talking about internally, and don't hold me to that, but we do want to create some separation between the two things, just so people I want to invest in ROK Oil, or I want to invest in ROK Lithium, right?
Okay, so one way would be to spin it out, and then ROK Resources hold a meaningful interest in ROK Lithium or whatever that might be.
So like if I just think about it, we could, ROK Resources could originally, hold those shares, right, of EMP or of whatever that entity is, and then if we dividended those out to shareholders, then that would be the mechanism where they would actually have a free trading share, and that's something that we've talked about loosely internally, just to, I guess, provide the ability for the shareholder to make a decision on what they want to own, and also here's what the lithium asset's worth on a day, and it's trading at X, and ROK Oil and Gas is separate. So we'll see how that evolves over the next 6 months, but it's it's the feedback we're getting and the conversations we're having. It sounds like people are open to that and actually want to see that happening. So
which company would become publicly traded? Would it be Hub City Lithium, or would it be a company that?
So EMP is already publicly traded.
Yes, I
right. So EMP Metals, they own the other 75% of Hub City. So perhaps it could be in the EMP Metal name, right? Maybe that's who ends up owning 100% of it, and then ROK would have shares in that. Does that make sense?
It's easy to extract the lithium, Brian, but how easy is it to get it permitted?
So yeah, it's to extract lithium, Brian, actually at a commercial scale is the hard part. So that's the DLE technology is the differentiating piece that has to happen or has to come to market where it's scalable to pick a number, 1,000 cubes a day, 10,000 cubes a day, right? And I know a lot of companies are doing it in the lab and maybe at pilot level, but to a point where it's economic at a very scalable quantity, we have yet to see that. And so that's what we own this resource. We believe we own the best resource, or one of the best resources in Canada for lithium, for lithium brine. And, it's a matter of then partnering with that DLE company and getting that, are we going to actually start selling lithium, in 12 months? It's really hard to say right now, but that's the biggest hurdle that the industry is facing right now. So extracting the lithium into this high concentration brine, then once it gets past that stage, it's pretty simple getting it to battery grade lithium, from what I understand. It's really just properly extracting it at the well site or at that initial facility.
So all in all, permitting is not an issue.
Correct. No, permitting, like we own, and I don't know the term, I don't know all the ins and outs of the leasing on the lithium. That would be a Jared question, but we own X acres now. We did sell off some of our non-core stuff up in the Kindersley area in Saskatchewan, but we own, just under 200,000 or 180,000 or something acres. That's all owned by us. That's all in place. There's some capital you need to spend over time to hold that, but there's plenty of time to do that. And that's, we're already spending some of that money. So yeah, the permitting isn't the issue. It's honestly just getting the extraction technology perfected.
The PA, will that cover both the Mansur and Viewfield area, or what will it incorporate?
Yeah, good question. We haven't, I believe it will cover, I believe it's project by project. So I think we would probably start with Viewfield, but, still haven't completely decided that in terms of will we put them together or will they be separate. Viewfield, as that's the primary target right now, just based on the concentrations and, the land base. But, both projects, in our opinion, are top tier if you look at lithium concentration and what we perceive to be operating costs and things like that between Saskatchewan and Alberta. So
the third pillar of ROK Resources investment case is the capital structure, which we, with the following questions, will investigate. If we move on to the capital structure, the management and board owns 17%. How much do you own personally?
Percentage-wise, I don't know what the percentage is, but I own, I believe, around 6 million shares, in and around that number. I think, Jared's a little bit higher than me, and Cam's, upward of 10 million shares. So between the three of us, what would that be? I can't do the math. Like we're over 20 million shares between the three of us. I think we're closer to 25 million shares, and so we're all in on this. Participated in, I believe, every equity raise. Jared and I have participated in the majority of them to some level. I was buying in the market last year. I bought actually some of the warrants that were trading and some commons. So, in the private space, we were just like, when I came out of university, it was an expectation that I would find some money to invest in the Villanovas, and I, continued to do that, and that's all I know. And Jared too, like we're in this as heavy as any management team, in our opinion, relative to net worth, I think. So yeah, we're alongside all you shareholders for the ride.
Well, that's great. That's the exact type of management team that you need. That the managed team that earns its money with the shareholders and not by bleeding.
Absolutely.
You are thinking of paying down the revolving credit facility, which is, as now, I think it's 15 million was drawn. But are you planning to pay it down completely?
I think we'll always want to keep that available. And rationale to, you had a question earlier about, if you go and do a tuck-in acquisition, can you use your line of credit? That would be the rationale for keeping something like that, right? And if we have an ability to pay that to zero, which we do, we could pull back capex a little bit, or just spend the money, cash flow it, and just pay that down and reduce capex over time. Or I that's always an option. But for us, having an open, accessible line is a nice lifeline if you need it. But also, if you want to go and do an acquisition, you don't have to go raise equity. You don't have to try and find new debt, things like that.
No, but no, I agree with you, and it's quite the cost of capital is quite cheap. 8% is it's very good for a smaller oil and gas company in this interest environment. All in all, when it comes to warrant and equity issuances, we shouldn't be. Your goal is, unless there is a huge opportunity, there shouldn't be any more of those. Great. There is a larger warrant overhang. What's the premium if you would like to repurchase stock warrants?
What can you negotiate with the buyer? I don't think there's a set premium. It's at least that I'm aware of. But if we were looking to repurchase or purchase back warrants, I think you'd put a tender out to market at some number, and I'm not 100% sure of the mechanism to do that, but I don't believe there's a set premium. And we've talked about buying back warrants, we've talked about buying back shares, and I think those are early 2024 decisions for us. I think right now we're focused on putting some capital into the ground in a responsible way, growing this base, growing our location count, replacing some PDP barrels, just firming up the quality of our assets, and getting this company, just continuing to improve the company month over month, right? And we have a lot of feedback saying buy back shares, do this, do that, and also say put it into the ground. So we believe right now the best use of capital and the best return is to put it into the ground. Fast forward 9 months, we might have an NCIB in place. We might be buying back some shares and some warrants, and the price of them right now is attractive. I will admit that.
Do you see any catalyst or future event that could get a larger portion of those warrants exercised?
Well, I mean, one of the catalysts would be if we ended up doing the lithium spinout and did a dividend to shareholders. That could, I guess, encourage people to exercise warrants if they want to participate in that. That's an option. outside of that, I think, most people, most of the time you have a warrant or, an option, you're going to hold it until expiry, until the last day that you can exercise that. And so, I would envision we don't have an ability to call those warrants, those 25-cent warrants. So we have had about 5 million exercised, and some groups, for their own internal reasons do that, but I don't envision that happening unless, there's a reason, say on the lithium side, that could happen.
We have all talked about this, but how will you in general deploy your generated free cash flows? Are you thinking of perhaps instituting a dividend in the future after you have, grown production to 4,000 or 5,000 barrels per day? Or
you know what, I'm gonna say no. Like, I don't think we're a dividend model. I think we're a growth model. I think, is there an ability to do a one-time or a special dividend? Yes. I think that could be on the table. Do we intend to convert to a divco? I would say no. I think for us, our focus will be growth. Our focus will be, creating that solid reserve base with, a bunch of upside locations. And, we're serial sellers, us three guys, and that's kind of what we've done historically. And I think that'll end up being the model here at some point. We're in no rush to do that. We don't want to sell in this market. I think there's a lot of probably M&A, acquisition opportunities at this price. But one day, I think, we'll have this company positioned to sell it and hopefully, see a nice return for everybody.
there was actually an answer to my last question, but I will ask it anyway. So where do you envision ROK Resources in 5 years?
Yeah, there you go. 5 years. Well, we could still be plugging away. We could be, 10,000 barrels a day in 5 years. But if I'm gonna bet on it, I'd probably say in 5 we'll be on maybe ROK number 2. Whatever whatever that next entity might be. But I think we're in this bullish environment, from a fundamental perspective and a macro perspective on oil. And I think, we want to take advantage of that and position the company at some point to sell. And so, could that happen in 2 years or 4 years? I don't know. I have no idea when that's going to happen. But and I think it will happen within 5. And hopefully, if the stars align, we're able to create something new and keep moving forward. But this is the industry we know and like, and who knows, that lithium thing could be still in play as well.